Hey everyone, I'm Sam and welcome to Financial Dragon. In this video, we will be talking about the crazy phenomena that is the disparity between the stock market and the world economy. More specifically, the US economy, and how this disparity can lead to a whole new era, and how you, the average investor, can prepare yourself for the possibility of this happening. If you want to see more content like this, then smash that like button, subscribe to my channel, and let's get right into it. So as we all know at this point, the economy is not doing too well. The worldwide pandemic has led to tons of people losing their jobs due to the changes in spending habits during the lockdown. And most of the people who still have their jobs are fortunately practicing social distancing and changing their lifestyle habits to not go out as much, thus reducing the risk of catching the illness and spreading it to others. But this has in turn led to businesses, large and small, making a lot less money. And especially bars, transport, restaurants, cinemas, clothing stores, and so much more. And as you can probably guess, businesses that stop making money are forced to cut their losses by at least temporarily laying off their workers. And as people start losing their jobs, they also stop getting salaries and making money, thus losing their purchasing power and only being able to pay for the absolute essentials, meaning housing, food, and maybe transportation. This in turn leads to them not spending as much on things such as going out or buying new clothes. This leads to the companies making even less money and cutting their losses by, you guessed it, laying off more employees. This is usually how a recession begins. The unemployment goes up and consumer spending goes down. And then over time, the supply and demand will reach a new balance. The government will step in with different kinds of fiscal support. The consumer spending will then slowly start increasing again and the economy starts to recover. This is all part of the standard economic cycle. This time is very special though, since a tangible so-called black swan event triggered the recession, which has led to a very unusual stock market reaction. At first, everyone panicked, and as companies started to worry about bankruptcy, the stock market crashed hard and fast. And as trillions of dollars was lost in the stock market in a matter of months, and as the unemployment rate just shot up, the government reacted with massive amounts of stimulus and shot trillions of dollars into the markets, and therefore pretty much bailed out the entire stock market, leading to the fast recovery and even the all-time highs we have today. I could go over what this looks like in detail in another video, but to put it simply, the total amount of money in the system, the so-called money supply, increased. Some of this money goes into regular people and regular households who need it to cover their cost of living. But a lot of it has gone to businesses and their wealthy owners. And these wealthy people have in turn used the money to buy right back into the stock market, thus increasing the demand of shares and driving up their prices. Also, whenever we assess the price of something, we also have to look at the alternative price of goods. Imagine if renting costs suddenly doubled overnight. This would lead to housing prices also going up a lot, since people suddenly find buying a house much more attractive. And in much the same way, as interest rates have gone down, buying bonds as a form of investment is suddenly not as profitable, which has in turn led to these people going into the stock market instead, also increasing the demand and driving the price up. So as you can see, the price of an asset, such as a stock, can go up without its actual value going up. A lot of the companies in the stock market and the whole economy in general is still going through really hard times. But as investors simply have more money to buy into the stock market, their valuations have increased. This is also reflected in the current price-to-earning ratios being sky high right now, meaning that the investors are expecting the stocks to have much higher prices than normal when you compare it to how much money they are actually making. To give you another example of inflated prices, you could buy a Big Mac for only 45 cents in 1967, but now, 53 years later, it almost costs $4 on average. Now the Big Mac is still a Big Mac. People are still expecting the same taste and the same experience, but the price is 9 times higher. So you see, the value hasn't changed, but the price has increased. So now you might be thinking, okay Sam, the stock market is overvalued and inflation is a huge risk. How can this affect me and my money? Well, the big thing everyone is scared of, which also makes quite a lot of sense, is a stock market crash. And yes, it is totally logical to be worried of your stocks going down 50% or more if the premise of the stock market being truly overvalued is actually true. But honestly, just taking a deep breath and at least partially staying invested in the stock market is what I would do, and here's why. Let's assume that the theory I presented earlier is fully correct, and that the stock market has in fact increased in price without actually increasing in value. What does this actually mean? Well, if the actual value of the companies in the stock market didn't increase at all since March, that would mean that as inflation starts catching up, you will be able to buy the same amount of stuff by selling one share of, for example, the S&P 500 index in March as you would have been able to buy if you sold it, well, after the inflation starts happening. And sure, while the prices of goods haven't gone up that much yet, the worries are quite high for the future when people start spending like normal again. This is very well reflected in the US dollar index as well, since it has gone down almost 10% from its all-time highs. And not to mention some very unusual phenomena, such as the lumber prices going up 3.6 times in just a matter of months. But guess what? The stock market has historically been a very good hedge against inflation, meaning it will go up and increase in price as the currency loses its value, just like any other product or thing. But it will go up even more as companies start growing and expanding over time, and thereby actually become more valuable. Now, if the US dollar crashes and loses its purchasing power in relation to the rest of the world, the companies might still face some headwind and go through tough times, leading to their stock going down in value. But as long as I own those tried and true blue chip stocks, I think I will be fine in the long run. And I would never sell out of the market now in preparation for a crash, since you never know when it's actually going to come. Imagine if you sold out today and had to watch in agony as the stock market kept going up year after year after year. But if you believe in this theory, after doing your own research and of course consulting a financial advisor, and are willing to take on some risk for a possible higher return, you could invest some of your portfolio into assets that have historically gone up in inflationary times. And since I am young and much more risk tolerant, this is what I have done. And since precious metals tend to go up in price during times of low monetary trust, I currently have a large amount of my portfolio invested in gold and silver mining companies, which of course would profit immensely if the gold and silver prices went up. Now, these investments are very volatile, so if I had a shorter saving horizon, I would maybe just invest 10% of my portfolio into the precious metals industry, with the rest of my portfolio still being invested in blue chip stocks. By doing this, I would sleep well at night, knowing that I would be fine in the long term even if a crash comes, while still leaving the possibility of making some money out of it. Remember, it's never about timing the market, and it's all about time in the market. And lastly, I'm just a random guy on YouTube, so please consult a financial advisor before you start making decisions with your money. That's it for today's video, guys. If you enjoyed this one, click that like button and throw a comment down below. It could be about a video suggestion, a criticism, a question, or just anything. It helps out the algorithm and helps me out a lot. And lastly, subscribe to my channel if you want to see more content like this. And thanks for watching, and peace out.